Hi everyone. In this video we're going to work on homework problem 4.1 from chapter 4 obviously, and I snipped out a version of the transactions that we need to record here in the homework packet. So again, you'll have that this detail in your paper financial accounting course packet, but I've just snipped it out here so we can kind of see it, and you can reference to this as well while you're working on the homework. I'll leave that in for you as well. So to begin, we've got our general journal here. It doesn't specifically say a year that we're looking at here in this problem. Zoom in a little bit, but I'm just going to put 2025 at the top, and then let's start in here. So December 1st is the first transaction here that we can see, and we purchased 2,000 of merchandise from Vendor Co. with terms of 210 net 30. So remember, that means that if we pay within 10 days, we can take a 2% discount, and it's due at least within 30 days. So to begin, we're going to record the fact that we are purchasing merchandise to resale. We're a retailer here in this problem. And so we're going to record an inventory increase, and then we can tell that we have these terms here, etc. That tells us that we're going to, we haven't yet paid for this purchase essentially, because we can see that we have specific terms related to the purchase of the merchandise, and we received an invoice in the mail. And so when it says paid the invoice, that's when we'll know that cash goes out. But until then, we're going to record accounts payable as our credit. And we can see, clearly 2,000 for the purchase. So we now have an asset of inventory worth $2,000, and we'll say Vendor Co. And let's just put the terms in. That's helpful information, and put the invoice number, etc. So some helpful information there. Okay, I'm going to copy down our entry just to have that as a little template. And let's say on December 2nd, let's see, we paid FedEx $250 in shipping costs for merchandise purchased from Vendor Co. So again, on this same purchase, and remember, when we're paying for shipping costs we're going to increase the cost of our inventory essentially. One way to think about that is we have to basically capitalize or record, this inventory that we're going to hold and then later going to sell. The cost for that inventory is not just the cost of the actual inventory, but also the cost of getting it to us. So we're going to include all those costs as an asset, kind of combine those all onto our balance sheet as an asset. And so we have $250. And this one says paid. So we're going to, and it has a check number there. So let's credit cash. And we'll just say FedEx check number 843 for our little explanation there. Oop, and then we're going to want to make sure our debits and credits equal. Okay. On December 5th, we returned $300 of goods to Vendor Co. and received credit memo number 22. So we are here's our original transaction up above on December 1st. And so with the return of the inventory, we're basically doing a reversal of this entry above, but just for a portion, essentially. So instead of crediting accounts payable, we're going to debit it to reduce it. And instead of debiting inventory to increase it, and I'm going to ignore these little errors, we are going to be debiting debiting inventory to decrease it as well. And then we had, what do we want to say for our explanation here? Let's just put in credit memo. We'll just put CM number 22, and we'll put Vendor Co. Okay. And so this essentially, like I said, again, is just a direct reversal of this first entry above to record the receipt of the inventory. And since we no longer have that inventory, and we're not going to be, we're returning it, so we're not going to make the payment for that piece of it. Put the R in there. We are going to reduce both of these accounts by the $300 related to the return. Okay. on December 8th, let's see what we got. We made our actual payment with check number 844. And I'm going to delete these ones out, and this is going to be a 3-part journal entry as far as the debits and credits goes. So let's look how we're going to get to that 3 parts, what those 3 parts are here. Okay, the first thing I'm going to put in, do my format painter here. I'm going to put in these 2 accounts first, and I want to talk about part of the 3rd account we're going to record here in a second. But before we do any of the actual accounting or anything, let's look back at the original entry here to record the invoice. And again, we have these terms where we get to take a discount if we pay within 10 days. So the first thing we need to do when we're looking at this payment is determine whether or not we made it within 10 days. And if we did, we can take a discount. And so when we received this invoice, it was the 1st. So 10 days after that, it's the 11th essentially. And we made this payment on the 8th. So we are within that time period to take our discount. And so we need to figure out what that discount is. And the first thing we want to do is reduce our accounts payable for the full amount, because the whole amount of the accounts payable needs to go away because we're closing out this amount due because we're making a full payment. So we're going to have to look back here. First of all, we had the first accounts payable of $2,000 when we got that full invoice. But then remember that we sent back a portion of the inventory, so we can subtract $300 from that original $2,000 to reflect the fact that the resulting accounts payable after the return is $1,700. So a credit originally, and I'll show you just real quick. Maybe a T account would be helpful here. So let's say this is our accounts payable. So you can see here on December 1st, we recorded a credit for $2,000. That's this entry. And then on December 5th, we recorded a debit to reduce an account for the return. And then if we take our credit minus our debit, we end up with the $1,700 payable that we owe them. And then here you can see we're making our payment to close this out. And then that brings both sides to balance essentially and go to 0. So hopefully that's kind of helpful maybe there to sort of visualize what's happening with the debits and credits, but you can also see it above in the debits and credits shown here in the general journal as well. Okay, so our accounts payable goes to 0, so all amounts due have been accounted for and closed out. But the question becomes, how much cash are we going to pay because we're taking a discount? And what is the accounting that we're going to do to reflect any resultant differences, right? So in terms of how much cash we're actually going to pay them, it's going to not be the $1,700 like we're kind of used to seeing when we make a payment on accounts payable, but instead it's going to take our $1,700 times 0.98 essentially, because we're taking a 2% discount. So we're going to pay 2% less than what the full amount is because we made it within 10 days. Okay. If we had made this payment on December 15th, we would have to pay the full $1,700. But since we're within the 10-day period starting on December 1st, then we can take the discount. So, and 0.98 is basically reflective of the fact that we are taking 2% off. So if it was 100%, it would be the 1,700, 0.98, 98% gets us the 1,666. And then to balance this debits and credits out, we're going to kind of do a very similar thing. We're going to take the 1,700, and we could there's a few ways we could do this. We could multiply this by 0.02 to be reflective of the other 2%. You can see the sum comes up to 1,700. Or we could take 1,700 minus the cash portion, just to do it with subtraction, to balance it out. Either way, it works fine. And then as far as we know, it's a credit account, and we have to think about this. Essentially, we're reducing the amount that we paid for our inventory. And like we talked above in all these different transactions, our inventory cost reflects the total amount that we pay for the inventory, including the shipping to get it to us. So if we're actually paying less because we took a discount, we're going to reduce the value of that inventory that we have by the $34 to reflect that the ending balance of the inventory on our balance sheet now is originally was 2,000, but we returned originally it was 2,000. We made a payment for shipping, then we reduced a portion because we made a return, and so we've got 1950. But then we're going to take a discount as well and reduce that further by $34. So our ending balance of inventory that's going to be on our balance sheet as an asset will be $1,916 then basically. Right, so original purchase, and I'll just kind of show this to you here. So this is original purchase. This is shipping costs. This is a return of portion of original purchase. And this is reduction of payment due to discount. So again, the resulting ending amount here, if we look at it, is $1,916. And you could, if I had done a T account for inventory, you would see the same thing with debits and credits. So just showing that there. Okay, let's remove our stuff there. Okay, so that was our payment. Let's just put a little explanation in. Let's say vendor co payment. It tells us what check numbers. That's valuable information. We'll just put that in. Check number 844. And so we've taken the discount, etc. All balanced out. So good to go. Okay. Our next transaction is going to be a sales transaction, and sales transactions are always 4-part journal entries. So again, I'm going to kind of start fresh here with all formatting, and we're going to need 4 lines here. And so the first part of this journal entry to think of is the actual proceeds that we received from the sale. So we received $5,000. Or sorry, we didn't receive the cash yet. We made the sale, and it was sold on account. We can tell it's on account because there's terms associated. So it mentions if you pay us within this many days, you can get a 1% discount. And we also see that there's some cost of goods sold. So we'll think about that here in a moment. So our accounts receivable, before we consider whether they're going to get the discount or anything, is $5,000. And then we have sales revenue. It's indent there. And that's basically the first part of the 4-part journal entry, essentially. And I'm going to actually just do this in 2 separate parts. But remember that any sale has 4 lines to it, essentially. Whether you combine those into 1 journal entry or 2 doesn't make any difference, really. And I'm just going to do it separately. Just I think it's a little more visual for you all to see the 2 different pieces. And we'll say sale. What do I say? Client co sale. And we'll put the terms in here just to have it available for us later. 110 net 40. And does it tell us anything else? I will put the invoice number in there too, just for the heck of it. INV. I'm going to do that above too, just to be consistent. Okay. Again, this is just, us kind of riffing on what the best information would be, but that's reasonable there. Okay, so that's the sales portion. And then I'm going to record the same date. It's the same date and all that stuff. Like I said, you could combine these or separate them. Just separating here. I'm going to leave the same explanation. But the second portion of this part of the 4-piece journal entry for every sale is the reduction in inventory, right? Because inventory is gone. So that's out the door. We don't have that on our balance sheet anymore. And that was $2,400, it tells us. And then we don't want to debit, accounts receivable here. What we want to record is then the cost of the inventory to go to our income statement as an expense. And that's called cost of goods sold, essentially. So this is the expense that reduces our sales revenue to reflect the amount that we had to pay to get that inventory in the first place to sell it. Okay, so these, again, they're all connected to the same transaction. I just separated them out so you all can see the different pieces a little bit more clearly, I think. Hopefully that's helpful. Okay, and then on December 10th, now we have the client co from this sale. Now they're returning a portion of it back to us, and they're saying, okay, we've got $500 that needs to come back, an inventory back to you all. And so we're going to want to record kind of in reverse, which I'll do this again on kind of split it out. So it's a 4-part return, then essentially is kind of an opposite to the 4-part sales transaction when we first recorded the sale. But now a piece of that sale is coming back to us as a return. And so we're going to first record the reduction in accounts receivable. So we're going to credit accounts receivable. And remember, we debited it here to increase it, but now we're decreasing it for a portion. And it was $500 that they paid, that they had purchased, but they're saying, we don't want this anymore. Here's your, this is a, we'll look at the inventory coming back to us, but we're going to reduce the portion that is receivable. So AR went up, now it goes down by the piece that we're getting back. We're going to debit a contra sales account. Same amount, like I said, 500, but we're going to debit a sales returns and allowances account. And that is going to reduce our overall net sales, essentially, right? So it's a contra revenue account. We recorded this much revenue to start, so up here 5,000, and then this is going to reduce our revenue down by 500 because they returned that portion of the inventory to us. And I'm just going to change the, there we go. And now, okay, so our sales have been reduced. Our revenue, I should say, has been reduced. Our accounts receivable has been reduced. We've kind of backed out that top portion. And then the second piece that we're going to reduce is essentially this portion of the original sale. And this is really just a straight up reversal here. So now we've got inventory coming back to us, not these numbers, I'll clear those out, but we've got inventory coming back to us, and we've got to reduce our cost of goods sold. This one's there's a little trick in this one that you have to do an extra calculation because it doesn't tell us what the cost of goods sold for this return was. So we have to do a little bit of math to figure out, first of all, what's the proportion of cost of goods sold to sales revenue, and then apply that same ratio or percentage to the $500. Because we know here the transaction before tells us it was $5,000 sales revenue, and it was $2,400 cost of goods sold. So if we do the division there, that tells us that for every dollar of sales revenue, essentially, we are going to I'll do it this way. For every dollar of sales revenue, let me put these out and maybe if we just want to do it with a decimal, I suppose. For every dollar of sales revenue, so we'll say sales revenue per. I'm sorry. Let me do this. Let me put it like this. 2,400. Yeah, this looks funny to me. I'm doing a division, but the denominator was on top. Okay, so now we can say cost of goods sold per dollar of sales revenue. A lot of teams, and let me fix this to be reflective of that. A lot of times in these problems, you'll be told the actual amounts, etc., of COGS and whatnot. So maybe you won't have to calculate that every time, but we can do it here. And this is just an extra little challenge for us in this problem. So if we know that for every dollar of sales revenue, we're getting 48 cents of cost of goods sold, then if we know we're having $500 of sales revenue returned or reversed, then the end cost of goods sold associated with that is just going to be the 500 times 0.48 or $240. So a little tricky, extra little wrinkle to this problem that you had to sort of figure that out. But hopefully that makes sense. Okay, on the 14th, we received payment from client company. So now we're receiving the payment for all these transactions here. And again, we're going to have a 3-part journal entry like we did when we took a discount on our payment. Now we're going to receive a discount, potentially. We have to look and make sure, and look at the timing and all that. So 14th. Oop, a little space in there. Okay. All right. So on December 14th, now we are being paid, and we're receiving payment from the client company. So we're going to receive cash because we're receiving that payment, obviously. We're going to have a reduction in our AR, and then we got to we have to think about what's going to happen to the rest of this whole transaction here. So similar to how we had to reduce AP by 100% to get it to go away, we need to do the same thing with AR to get it to go away 100%. And then think about the discount, right? We want 0 AR. So our AR started at 5,000. We reduced it by 500. They, for the return that they provided, and now they're paying us off in full. So the resultant amount of receivables that's then going to need to be credited to reduce it to 0 is $4,500. So you've got the 5,000 originally reduced by 500, and now we're reducing the rest of it through our receipt of cash. And then we have to look and see whether they took that discount because they're within the time frame. Okay, so the original sale said they could take 1% if they paid within 10 days, and that was on December 9th. And we're on December 14th. So since they made so it's only been 5 days since December 9th. So it's within the 10-day time frame. And we are going to, let me do this real quick. When did we, payment received from, we'll just say client. Go. Okay. So yeah, first thing, AR goes to 0. Now, the amount of cash that we're going to receive, they did pay us within 10 days. They get a 1% discount because they did that. So they owed us $4,500, but they're going to pay us only 99% of that because they're taking the 1% discount. So they're going to pay us $4,455 of cash. And then again, we can either take 0.01 times the 4,500 to get the other piece to total up to the same amount, or we can just do math to subtract the AR from the cash proceeds to again get the same total 4,500 debit and 4,500 credit. And the account that we're going to use here is another contra revenue account like we had above for sales returns and allowances. But this time it's going to be called sales discount. And so that's going to, again, reduce our total gross sales down to a net figure, essentially. Okay, and just to highlight one thing, the reason why we don't just reduce sales directly and we use these contra accounts is because it allows us to better analyze and track the discounts and returns separately from the sales so that we can get a feel for what's the percentage of our sales coming back, and what's the percentage of our discounts that we're offering when you look at a financial statement. Because if we just debited sales revenue, like to reverse it, like up here, we just reverse that original entry, that would get us kind of to the same place, but it wouldn't allow us to so easily identify how much the discount was because it would be buried in that ending sales revenue number. So just something to think about, like why are we doing that? Why are we using these contra revenue accounts? All right, so let's see where we at now. On December 16th, we purchased $5,000 of goods for resale. So another purchase transaction. So we can just go up and I'm going to steal our original entry here, and I'm going to move this down so we can kind of see it as we go. And this is which one is this? The 16th here. So we got inventory, 5,000, I think it said 5,000, yeah. So same, account on account. Here's our terms, 3.5, and we're going to call this wholesaler co. And it was 3% discount within 5 days, and then you net 45, so you have to pay within 45 days. And it was invoice 298. Okay, so we're good there. And then the next transaction on the 18th it's a sales transaction. So I'm gonna go steal again these two journal entries because they're very similar to what we're going to be doing again. So just make it a little easier on ourselves. And this is December 18th. And accounts receivable. Oh, I'm sorry. This is, yep, I made a mistake there. Sorry, let me back all that out. That's a later transaction on the 19th. On the 18th, we're issuing the check to the wholesaler. So we can take our journal entry here last time for a payment with the discount. So let's steal this one. And let's delete out all this, the links, kind of make it go funny there. And we're going to reduce our accounts payable. We know that by 5,000. Remember, that's always the first thing, is just to get rid of your AR or AP, because that always has to go to 0. And then we just need to figure out whether or not they're able to take the discount is kind of the next thing here. And this is wholesaler co. I'm just going to put this down here. And so we purchase the goods. It needs to be paid within 3 days. This is the 18th, which is 2 days after the 16th. So we are within 3 days. 2 days is less than 3 days. And so we do get a discount. So again, the amount of cash that we're going to pay is not 100%, but instead it's going to be 97%. Oops. Times 0.97. So 48.50. And then the difference is going to reduce our cost of inventory because we're paying less for the inventory essentially, and by taking the discount. And so that's reflected there above. Okay. Actually, I'm just going to make some more lines because we're running out of space on our general journal here. Lots of transactions in this one. Okay, so on the 19th now we have a sale. So now I'm going to go steal my 2 sales entries again from above. And we sold $2,500 of merchandise. So I'm just going to put the terms in, and this is being sold to Consumer Co. It says, and it's 110 net 40. So that's the same. It doesn't tell us an invoice number on this one, so I'm just going to take that out and leave the rest of it there. Copy it down. These are both related to the same transaction. So we've got accounts receivable, and we know what the goods cost us, $1,800. So that's a reduction of inventory for $1,800 and a recording our cost of goods sold then for $1,800. And finally, the very last transaction here is us receiving the payment. And we need to look at this one and decide, what is it within the time period that they will get a discount. And so just kind of looking at this one, first of all, you can tell it's been, let's see, 19th to the 31st is going to be 12 days later. And they needed to pay us within 10 days to get the discount to us, and they did not. So they're not going to get a discount then. Oh, sorry, let me fix the date here, December 19th. So they're not going to get a discount. So we don't really need a 3-part entry on this one. Instead, we just need a 2-line entry, and just what we're kind of used to, cash for $2,500 and accounts receivable for $2,500 here. Accounts receivable. And then that will just reflect our total payment of 100% of the accounts receivable because they did not pay us within the discount period. All right. Well, thanks, everybody. Hopefully that's helpful, and we'll see you in the next problem.